Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Redwire.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, let's unpack Redwire. Because, when you think about the space economy, your mind immediately goes to the big rockets, the flashy launch providers.
Right, or the huge satellite constellations. That's what gets the headline.
Exactly. But Redwire is playing a totally different game. It's a much safer role, you could argue. They call themselves an integrated aerospace infrastructure provider.
Which is a bit of a mouthful.
It is. But that framing is key. It's the whole picks and shovels idea.
That's it. They aren't betting on which company wins the space race.
They're just betting that the race itself is happening.
Exactly. They build the stuff that absolutely has to work no matter whose logo is on the side of the rocket. We're talking solar arrays, the giant wings that power these things.
Antennas, docking systems, the really critical hardware.
The plumbing of space, basically. And these things require incredibly long certification cycles.
Which sounds like their first real competitive moat, right? Once NASA or a big prime contractor qualifies your hardware.
It's very, very hard to get kicked out. The switching costs are huge.
But that's not the whole story with them, is it? There's this dual domain strategy.
This is what makes them really unique. They have the space stuff, yes. But they've aggressively moved into uncrewed aerial systems, UAS.
Drones. This is the Edge Autonomy acquisition from 2025 we're talking about.
Correct. That brought these high-performance tactical drones, like the Stalker and the Penguin, into their portfolio.
So the obvious question is, why? Why would a space infrastructure company suddenly get into atmospheric defense drones?
It seems like a huge leap, but it's actually a brilliant synergy. It dramatically changes their relevance, especially right now.
Because of the geopolitical climate?
Precisely. It means they're not just selling to space agencies anymore. They're now selling integrated systems to the U.S. and, crucially, to NATO defense budgets.
So they've tapped into this massive and growing pool of defense spending in Europe.
And just like the space hardware, these defense contracts are incredibly sticky. Long certification, high costs to switch. It gives them multi-year revenue visibility.
Which brings us to the financials.
Yeah.
Because the numbers really seem to back up this idea that the strategy is working.
Yeah, the revenue growth has been, well, it's been compelling. Q3 of fiscal 25, they hit about $103 million.
And the growth rate on that was the important part.
Over 50%. Year over year. That's not just a small step up. That's a genuine inflection point. It signals they're moving into scaled production.
And the story that really caught the market's attention, the thing that validates that whole dual domain idea, is Europe.
Oh, the European growth is just phenomenal. For fiscal 24, their revenue there grew 117%.
117.
To about $154 million. I mean, think about that. Europe is now more than half of their total sales.
And we're seeing this translate into some really high-profile contracts. Let's talk about the docking systems for the exploration company, for their Nix spacecraft.
That's a huge win. Nix is being positioned as, a piece of future commercial space station infrastructure. By supplying the docking hardware, Redwire is putting itself at the absolute center of that. They're building the front door everyone else will have to use.
They also got that payload integration deal for the ESA's Syndio 3 mission.
And that builds on their work for Axiom Station, supplying the solar arrays. It's this virtuous cycle. Every successful program makes them the default choice for the next one.
Which is why that backlog number is so important.
Yeah.
What's it at now?
Around 356 million. That's a huge cushion of future revenue just sitting there waiting to be recognized.
Now, they did revise their 2026 guidance down a little, from 520 million.
Yeah, down to about 475 million. And, any downward revision gets scrutinized.
Of course.
But you have to look at the context. 475 million still implies very, very strong continued growth. It's not a disaster by any means.
Okay, so the top-line story is solid, impressive even. The contracts are there, but we have to talk about the other side of the coin, the profitability.
This is the necessary reality check. This is where the bull and bear case really clash.
So on that $103 million in revenue last quarter, what was the gross profit?
Only about 16.8 million. So if you do the math, their gross margin is in the mid-teens.
Which is low for this sector, isn't it? A mature defense contractor is usually aiming for, what, 25% plus?
Absolutely. It's a number that makes you pause. It tells you they're still absorbing costs from scaling up and probably taking lower margins on these big contracts to win the business.
And that flows directly down to that big net loss number.
It was substantial, a net loss of around $41 million.
So, let me get this straight. They burned $41 million in a quarter to generate $103 million in sales.
Yes. The profit margin was negative 93%. It's a huge cash burn.
So what's the justification? What's management's strategy here?
They're being very open about it. It's a land grab. They are trading today's profits for tomorrow's market share.
Where is that cash actually going?
Two main places. One, integrating edge autonomy and scaling up the drone manufacturing. Two, just massive R&D for these complex platforms that serve both space and defense. They're spending now to qualify for the next decade of government budgets.
It's aggressive.
Very. It's a high-risk bet that once they're the established leader, the sticky contracts will let them raise margins back to a healthy level.
Which leads to the big question about their financial health. How much runway do they have to keep burning cash like this?
Well, right now, the vital signs are adequate. Their current ratio is about 1.4, so they can cover their short-term bills. It's not a crisis situation.
And their debt load?
It's actually quite low. Debt to equity is around 0.24. Leverage isn't the problem. The problem is the rate of cash consumption.
And that brings us to the elephant in the room. The 2026 financing risk.
Absolutely. The analyst consensus is pretty clear. Given this burn rate, they will almost certainly need more cash in 2026.
And if they have to issue new shares to get that cash, that means dilution for everyone who holds the stock now.
Which puts pressure on the price. That is the number one risk the market is watching.
But there is a bullish counter to that, right?
Yeah.
Using their backlog as leverage.
Exactly. If they can go to a lender and say, look, we have hundreds of millions in guaranteed government and ESA contracts, they might be able to secure non-dilutive capital. A loan, basically.
But if they pull that off?
That is a massive de-risking event. It solves the financing problem without hurting shareholders. That's the dream scenario for the bulls.
So let's talk about how the market has been reacting to all this mix of great growth and scary cash burn.
The stock price has been on an absolute tear.
It really has. Up nearly 50% in just a couple of weeks.
And it was directly tied to that string of positive contract announcements. We saw days where it was up 8, 9%. Another day, it jumped almost 15%.
What does that kind of aggressive buying tell you about the market's thinking?
It says the narrative is shifting. People are no longer seeing this as just another speculative spaceback. They are starting to reprice it as a legitimate, scaled defense and aerospace contractor.
Every new contract win from NATO or the ESA just validates that thesis a little bit more.
Right. But that momentum happened right around the time we saw some pretty significant insider selling.
From A-Red Holdings, that was back in January.
Yes, they sold about 2.7 million shares. And on the surface, that looks terrible. A major insider dumping stock.
But the context matters here.
Context is everything. First, this was right after that huge price rally. It looks a lot more like simple profit-taking than a sign they've lost faith.
And didn't the CEO and CAO make some purchases before that?
They did. They were making open market buys, signaling their own confidence. But here's the most telling detail for me.
What's that?
The market just ate up all those shares. On the days they were selling millions of shares, the stock still traded up 6 to 8%.
Which means there was huge underlying demand from buyers who were happy to step in.
Exactly. The institutions see the long-term story and are willing to absorb that supply.
Okay, so let's try and synthesize the key risks here. What are the two main things that could go wrong?
I'd say the first is fixed price execution risk. These are complex programs. The next docking system, the Axiom arrays, if there are cost overruns or delays.
The thin margins could just vanish.
Poof,
Yeah.
gone. And the second risk is the one we already talked about, dilution risk. We know they need cash in 26 if they can't get it through debt.
They'll be forced to sell stock, and the share price takes a hit.
Those are the big two. But on the flip side, we have a very clear calendar of catalysts to watch.
So what should you be looking for in the next few months?
First up, the full FY25 results. They're coming in the next few weeks. We need to see that European growth continue, obviously. But the key metric will be the cash burn.
Any sign of it slowing down or stabilizing would be huge.
It would be a make-or-break moment. And beyond that, just keep an eye on progress reports for those big programs. Syndio 3, NICS, every successful milestone reduces that execution risk.
So what's the final thought here? You have this high-growth, high-momentum company transitioning from a cash-burning startup to a real, scaled player with serious government backing.
It's a classic asymmetric opportunity. You've got this massive momentum, the European contract wins are huge, and I still think the defense side is underappreciated. It's a high-growth, high-risk name.
This really feels like a name you need to look at on a 12 to 24-month horizon. You're making a bet that they can successfully navigate this transition and turn that giant backlog into actual, reliable cash flow. It's an execution story.
It is. It's a bet on management. If you want to keep up with our analysis on companies attempting this crucial transition, make sure you subscribe to the show for our next market breakdown.